Yesterday's U.S. stock market performance was a real gut punch. It was cruising along just fine, and then bam, some comments from an old guy sent it into a sudden nosedive. I bet tons of people lost sleep over it last night. Like me, I'm sure plenty were caught totally off guard. The Nasdaq plunged more than 1% intraday while the S&P 500 and the Dow also dropped across the board. All three major indexes hit their daily lows at the same time. Panic spread everywhere, and social media was flooded with investors venting their frustration. But you know what's wild? What triggered this sell-off wasn't bad earnings reports or geopolitical tension. It was just one sentence from Fed Chair Jerome Powell. In his latest public speech, Powell straight up said, U.S. stock market valuations are quite high. That's it, that one simple line, and the market instantly went into a tailspin. Why? Because it signals that even the Fed thinks the stock market bubble has been blown too big. Let's be real. Everyone knows the rally over the past 2 years has basically been fueled by liquidity and carried by a handful of big tech giants. So when Powell himself hints that things are too expensive, how can the market keep pretending nothing's wrong? That's why yesterday's plunge felt like a balloon getting popped. All the air went out in a hurry. But here's the even scarier part. Powell also hinted at a more dangerous signal. He said monetary policy now faces two-way risks, meaning there's no clear, safe path forward. What does that mean? If they cut rates, inflation could flare up again. If they tighten, jobs could take a hit. It's like being stuck between a rock and a hard place. And this comes just after the Fed started cutting rates last week, which makes investors even more nervous. Is the Fed just firefighting now? Is it reacting? Not leading. During his speech, Powell repeated a risky reality. The U.S. economy is facing those two-way challenges. On one side, inflation is still stubbornly high. On the other, the job market is cooling down on the surface. The unemployment rate still looks okay, but underneath, hiring has slowed. Companies are cutting jobs more often. And young people are finding it harder to get work. Powell didn't sugarcoat it. He said the U.S. labor market can no longer be called strong. So why did the Fed cut rates last week? That's exactly why, to keep the job market from totally falling apart. The Fed had to inject stimulus preemptively. But guys, is inflation really solved? The answer is no. Powell admitted in his speech that inflation still faces upside risks in the short term, and the main driver is the Trump administration's tariffs. Even more puzzling, he used the term one-time shock. He said the inflationary impact of tariffs is temporary, not long-lasting, but here's the thing. One time doesn't mean it disappears immediately. According to most forecasts, this price shock could last until 2026. 2 years is more than enough time for multiple market storms, so see what's happening. This is Powell's dilemma. If he keeps cutting rates, inflation could bounce back. If he pauses, the job market might crash. Basically, the Fed is stuck between a rock and a hard place. Every move looks bad right now, and the market isn't dumb. The second, Powell said stocks are fairly high. The Nasdaq dropped over 1%, and the S&P and Dow dipped into the red. For years, the Fed tried to avoid feeding a stock bubble, but this time Powell basically poked it with a pin. Why? Because he had to say it out loud. Prices are too high. The bubble is real. What's more striking is that he emphasized that even after the recent cut, policy rates remained moderately restrictive. What does that mean? It means the Fed hasn't fully switched to massive easing. It's keeping its options open. For the market, this was a cold shower. Many were expecting a strong rate-cutting cycle, but Powell threw cold water on that idea. Don't get ahead of yourselves. The Fed won't unconditionally flood the market for the sake of stocks. So here's the question. Friends, Powell is warning about high valuations while starting a rate-cutting cycle. Who actually benefits? The answer is harsh, not the vast majority of us, but the top 10% who truly hold America's wealth. The latest data shows that the wealthiest 10% of Americans own over 92% of all stock assets. This means the rise and fall of the stock market has almost no direct impact on most ordinary families. You might find it strange. Isn't the stock market for everyone? But the reality is, ordinary American families don't have much money invested in stocks. Especially low and middle income households, their wealth is mainly in their homes, savings, and pensions, not in tech stocks. This means that at the start of every rate-cutting cycle, the first to benefit are always that small group of wealthy people holding massive assets. Lower rates bring liquidity, pushing up stock prices, home prices, and bond prices, directly inflating their wealth. And those without assets, they face two outcomes: stagnant wage growth and rising living costs due to inflation. In other words, the Fed's so-called economic rescue effectively becomes a rescue for the rich in terms of real wealth distribution. This is why the wealth gap in the U.S. keeps widening. That happened in the 2008 financial crisis, again in 2020 during the pandemic, and now in 2025, it's the same story. Think about it. When Powell said yesterday that stock valuations are quite high, the market immediately tanked. But does a market drop really hurt the top tier? Not necessarily. They have enough cash flow hedging tools and global portfolios. The ones who really get hurt are often retail investors who bought in at the peak. And the harsh truth is, most of those retail investors aren't wealthy to begin with. So here's the policy paradox. The original goal of cutting rates was to save jobs and stabilize the economy. But how it plays out in the market only makes asset holders richer while making life harder for those without assets. If you think this is just theory, let's look at history. After the 2008 crisis, the Fed slashed rates to zero and launched unprecedented quantitative easing. Within a few years, the U.S. stock market experienced a Super Bowl run, with the Dow soaring from 6,000 to over 18,000. But did ordinary families' incomes and wealth recover? No. The Fed's own data later made it clear, in the decade after the crisis, median U.S. household wealth barely moved, while the top 10% saw their wealth double. During the 2020 pandemic, the Fed again flooded the markets with liquidity. Do you remember? The stock market rebounded at a record pace in just months, with the Nasdaq even hitting new highs prematurely. But at the same time, how many ordinary American families were losing jobs or going bankrupt? At the peak of the pandemic, over 20 million Americans were unemployed. Many were crushed by living costs before they could even enjoy the stock market rally. Now look at 2025. The Fed just announced a rate cut. What's the market's first reaction? Tech stocks and growth stocks are back in favor. But you need to know that 92% of U.S. stock assets are held by the top 10%. So even if the market rallies another 10% or 20%, the bulk of the wealth won't flow to ordinary people. It will continue to be sucked up by that small group. This is why America's wealth gap is getting worse. The top tier not only owns more stocks, but also has access to more powerful financial tools. They can amplify gains through hedge funds, private equity, and alternative investments. What about ordinary people? Many are struggling to pay their mortgages, let alone diversify their investments. So, when Powell said stock valuations are quite high yesterday, many people's first thought was, is it going to crash? But I'd say, even if it does crash, the ones who will ultimately be rescued are still that top 10% because they not only own stocks, but they also have policy backing. Those without assets, once again, they are left behind. Friends, the wealth distribution issue isn't just a numbers game. It's a real force tearing American society apart. You probably remember, over the past decade, the biggest social label in the U.S. has been polarization. The divide between left and right keeps growing, populism surges, and young people's anger intensifies. Why? The core reason is the ever-widening wealth gap. The latest data tells us the top 1% in the U.S. controls close to 35% of the wealth, while the bottom 50% combined own less than 3%. And when it comes to the stock market, it's even more extreme. The top 10% firmly hold 92% of all stocks. What does that mean? It means the daily ups and downs of the stock market, the so-called bull market you see in the news. For most ordinary people, it's just like watching a show. They don't even have the chips to get in the game. Do you remember Occupy Wall Street? That was the most direct public backlash after the 2008 financial crisis. Ordinary people realized that Wall Street created the disaster, but in the end, it was Wall Street that got bailed out, not the middle class, who were buried in mortgages and saw their wealth evaporate. More than 10 years have passed. Has anything improved? No, it's actually gotten worse. After 2008, the Fed kept policies loose for a decade. The stock market had an epic bull run, but median household wealth barely moved. In fact, many families sank deeper into debt. The real winners were always those with the most assets, the ones closest to the Fed. This divide hits young people especially hard. The job market is already weak. Powell himself admitted yesterday that the labor market has now shown substantial softening. Young people either can't find jobs or can only accept low-paying work. Meanwhile, they watch helplessly as tech stocks, luxury homes, and Bitcoin soar, completely priced out. There are even surveys in the U.S. showing that over half of young people today don't believe they can achieve a middle-class life through hard work alone. Because when they're earning a few thousand a month, the asset markets have already set entry barriers in the hundreds of thousands or millions, locking them out of wealth accumulation. This is why young Americans are getting angrier. Why are so many drawn to extreme politics? Why is social media filled with rage against capitalists? Because what they feel is an opportunity, but abandonment. For them, rate cuts don't signal future hope, but higher rents, more expensive living costs, and a more distant wealth dream. In other words, so-called monetary easing is a wealth amplifier for the top, but an amplifier of survival pressure for the bottom. More frighteningly, this social division is now feeding back into politics. The tariff policies launched by the Trump administration, on the surface framed as protecting the nation, have actually worsened inflation at home, directly squeezing the living space of ordinary families. And to counter the employment pressure, the Fed has no choice but to cut rates. What's the result of this policy? The wealthy keep partying in the asset markets, while ordinary people keep getting squeezed by inflation. The top counts their gains in the stock market, while the bottom counts every penny for eggs and milk at the supermarket. In other words, America's problem today is no longer just the economic two-way challenge of inflation and employment, a systemic crisis of social division. Powell's speech was subtle, but the market sees it clearly. Once a rate-cutting cycle starts, the flow of wealth is always upward, from the ordinary many to the privileged few. America's prosperity, on paper, looks like GDP growth and record stock markets. But in reality, the social pyramid is getting steeper, with the vast majority left at the bottom, falling further behind. If saying 92% of stocks are held by the top 10% still feels abstract, let's look at the real wealth changes during the pandemic years. According to Fed and Forbes statistics, from the start of the pandemic in 2022 to the end of 2022, the net worth of the wealthiest 1% of Americans increased by over $8 trillion. Meanwhile, the wealth of the bottom 50% barely grew, and many saw their assets shrink due to debt and rising costs. In other words, during the pandemic, the Wall Street elite saw their wealth double from clicking mice at home. The ordinary people at the bottom had to risk infection delivering packages, driving Ubers, or working in grocery stores. What did they get in the end? Not asset gains, but higher rents and rising food prices. Now, look at the longer-term data. From the end of the 2009 financial crisis to today, the S&P 500 has surged over 500%. But the median American household wealth, it's increased by less than 30%. What does that mean? It means the wealth curve for the top and a life curve for the bottom have completely split apart. For a small minority, these were the golden years. For the majority, it was a decade of being left behind. This is also why anger is growing in American society. Young people scroll through social media, watching Silicon Valley giants hit trillion-dollar market caps overnight, then look at their own paychecks only to find that after rent, loans, and health insurance, there's almost nothing left. The wealth gap is no longer some abstract statistic. It's a daily pressure every ordinary person can feel. When Powell emphasized in his speech yesterday that stock valuations are quite high, the market didn't just panic because stocks are expensive. It's because everyone deep down knows that this game was never fair in the first place. For regular folks, lower interest rates just mean prices going up again and wages staying stuck for years. But for the top tier, it's a wealth amplifier, a machine that constantly siphons money away from the bottom. This is the harsh reality of America today. Policies claim to be for full employment and economic stability, but the real beneficiaries are always the top 10% who hold assets. That's for the other 90%. They don't see prosperity. They see a wealth gap getting steeper and steeper. So, friends, this is why we must think clearly. What should the ordinary investor do? We can't change Fed policy, and we certainly can't reshape wealth distribution, but we can at least decide whether we'll be passive victims in this game or proactively find a way to survive. When the rate cutting cycle begins, the top tier will naturally continue harvesting gains in stocks, bonds, and real estate. What about us? If we blindly follow the hype chasing a so-called bull market, we'll likely end up being the ones holding the bag, buying at the top for their profit. But if we learn to position ourselves more wisely, we can at least avoid being the ones repeatedly harvested outside that privileged 92%. Here are 3 approaches I want to share with you. First, build a base of defensive assets. Second, be selective about which sectors you invest in. Third, keep your positioning and your emotions in check. These 3 steps might not make you rich overnight, but they can help you protect your chips while wealth is being drained away from most people. First layer, defense comes first. Let's be real. A rate-cutting cycle might push up risky assets in the short term, but it also fuels inflation. So safe haven assets like gold and silver are still essential for your core holdings. You might not make huge returns from them, but they'll help you avoid being wiped out when the market crashes. Don't forget, central banks are still buying gold like crazy this year. That's no coincidence. Countries are hedging against currency risks. Second layer, sector selection. It's true that U.S. stocks are highly valued, but not every sector is a bubble. For example, manufacturing and energy equipment, which benefit from tariffs and localization trends, could see independent growth with policy support. Then there's healthcare and consumer staples. Sectors tied to daily necessities often provide steady cash flow even during volatility. Instead of blindly chasing the Magnificent 7 AI stocks, look for overlooked structural opportunities. Maybe even check out undervalued markets outside the U.S. Third layer, mindset management. In a rate-cutting cycle, the biggest trap is the illusion of prosperity. Many people think money is flooding the system again. Should I use leverage and go all in? But here's the problem. The top tier has risk controls, hedges, and exit strategies. The biggest fear for ordinary investors is using short-term money to gamble on a long-term bubble. So instead of trying to run fast, focus on running steady. Maintain flexibility in your positions. Learn to take some profits gradually on the way up, rather than going all-in recklessly. In other words, Powell's speech yesterday wasn't just a warning to the market. It was a reminder to every ordinary investor. Don't get addicted to the valuation illusion. And don't fantasize about outperforming the top tier in the flood of liquidity. Instead of being someone else's liquidity exit, focus on strengthening your own foundation first. In today's video, we've broken down Powell's speech from yesterday, the two-way challenge, high valuations, the door opening to rate cuts. On the surface, it's a minor monetary policy adjustment, but in essence, it reveals the truth about wealth distribution in America. The top 10% owns 92% of stocks. Once rate cuts begin, the biggest beneficiaries are always those already rich in assets and ordinary people. They feel more the pressure of inflation, rising living costs, than the ever higher barrier to owning assets. This script has played out repeatedly over the past 15 years, 20 million, 82,020, and now 2025. After each crisis, the social fabric is torn a little deeper. So, rate cuts aren't a dividend for all. They are a vacuum for the top. The longer the stock market boom lasts, the faster wealth concentrates. For the ordinary investor, the biggest danger isn't market volatility, But blindly believing you can play the same game as the top tier, what truly protects you is a defensive core, smart sector choices, and a steady mindset, not chasing an illusory boom. Finally, let me ask you a question. Do you think this rate-cutting cycle will widen America's wealth gap even further? And as an ordinary investor, what else can you do to protect your own chips in this game? Drop your answers in the comments below. I'm at Ian. See you in the next video.